Hey everyone, welcome to today's live stream. It is Monday, May 29th, 2023. Hope you're doing great. Markets closed today, but I wanted to touch base because last week the Canadian market was closed. I was off, took the day off. Well, just didn't do a live stream, a lot going on. But I want to share a couple strategies that I've been using that have been working out really well lately. And this is a strategy that I have found that doesn't work for every single stock, but it works for what I call option-rich stocks. So let's go over it. This is a company I found on Stock Rocket, Symbotic Inc. It's had a nice move lately. It's threaded. You can see right here, the stock price, the blue went above or in between the red and green, and then we've got green on top of red. Perfect chart for a stock to move considerably higher. So let's say you buy 1,000 shares, and your investment is 36,000 in the stock. So the chart looks like perfect for it to go higher. So you're going to make money with the rise in the stock price, but also with the option contract. So I'm going to share with you a strategy that I invoke on every single holding that has an option contract available to it. Now, this only works if you buy minimum 100 shares. 100 shares, it's called a round lot, 100 shares. And typically for the US, it works. Most companies that trade above $7 a share have options contracts available. In Canada, it's about $12 to $14 have contracts available. So clearly, Symbotic at $36 would have contracts. So you'd want to at least buy 100 shares. 100 shares would cost you $3,600 as of Friday's close. So once you have your shares in your account after you purchase them, you then look at the option chain. And here is, so I type in the ticker symbol SYM. I'm on Yahoo Finance, by the way. No matter what country you live in, Yahoo Finance has representation there. So what I look at are what is called out of the money. Notice on the screen, you've got blue and then white. Blue is called in the money. That means the stock current price is trading higher than the option strike price. The strike price is exactly the price you will get if the stock is called out of your portfolio. So let's say you're buying the shares today at $36.10, or let's say it opens tomorrow at $36.90. You can scroll down for June 16th. So this would be every contract expires on a Friday. So Friday's expiry date. And we're looking at the June 16th, strike price $40. And you're going to be paid to sell this option contract to someone. So whenever you sell something, as you know, you get cash back. So you're going to be paid $1.25 per contract. And when you have 100 shares, you get one option contract. One option contract covers 100 shares of stock. So you would get $125 to sell this contract. Now, that's for 100 shares. If you had 1,000 shares, you're going to receive $1,200.50 for this option contract. So you immediately receive the option premium. You get to keep that regardless if the stock is called out of your portfolio, always called at the strike price. And here's the expiry date, June 16th. So consider this as a really great way to get additional income into your portfolio. And I know I just gave you a very cursory look at options, but you'll want to we're going to upload, we're expanding our teaching portal, and I've taught option contracts and put contracts in the past, calls and puts. So we're going to make that available for you at a really great price if you're interested in learning more about options. I recorded 3 hours of content on calls and 3 hours on puts. Options are just a great way to hedge your portfolio, to get extra income from the contracts. They're just great, great things. So worst case scenario, I'm buying the stock at $36, and June 16th, let's say the stock trades higher than 40. 40 is my strike price. Remember, I'm out of the money, not in the money. Blue is all in the money, easy to see. Strike price at $20 or to 35. Those have already, basically, as of right now, your stock would be called away from you. So that's a great strategy. If you've already had a position in your portfolio that's reached your target price, you simply sell a covered call against that stock at, like, just do the math. You've got 2250s right here. The bid is 9, so that would get you out at 3150 total. Now, you wouldn't consider that because the stock is higher. It's 3610. So you just want to, kind of poke around. These look good. The 30s at 820. So you'd get an execution. You get a total. You would get the last price 820 plus 30. That's 3820 out of the stock. But I like just below that in the money contract. So I would go for the 40s. I'd get paid $1.25. Here is a company that has super rich options, but it's pricey. It's a $380 stock, but it's Netflix. And every single Friday, so June 2nd, this coming Friday, we've got, now look, the stock is at $381 after hours. So you would scroll down and look at the 380 look at these options, $8. That's $800 per contract. So if you have 100 shares of Netflix, you're going to receive $800. If you have 200 shares of Netflix, you would receive $1,600 US right into your account. And then what happens if the stock doesn't hit that level? Actually, I would look at the 382.50s at $7. So you're going to receive $100 less per contract, but you've got a strike price much higher. Actually, the closer I look at these, I'd go with the 385s. Actually, get paid $600 per 100 shares, and then if the stock hits that 385 mark, you get it called away. Plus you get the $6. So your exit point would be $391. Very cool. Let's say it doesn't get called away. Let's say it doesn't hit $385 by Friday. Then come Monday morning, you just sell another covered call. Hope this is helpful for you. Have an amazing trading week, and I'll see you next Monday.